I started my first life insurance policy when I was 24 years old. Today, I have $15 million in life insurance and cash value that I've used for my business, real estate, and income gaps along the way, all tax efficiently. Here are 7 reasons your 30s are the perfect time to get life insurance. Reason number 1 is why most people never even start. A lot of people often run away from life insurance and never even give getting the policy a shot. And there's usually 3 reasons why. First, products like whole life insurance and universal life insurance are complicated. Most people are not going to put their money somewhere that they don't understand. It doesn't make any sense. The second reason, life insurance has a bad reputation. The thing is, these products can be set up beautifully and really benefit the consumer, but the majority of life insurance policies sold are not set up in the customer's best interest. And number 3, on the surface, it's viewed as a cost. The thing is, all 3 of those points are often used to say that life insurance is bad or it's a scam. Life insurance has a poor reputation because of the specific products people are introduced to and the way that those products are sold by agents. Now, most people have heard about whole life insurance, but almost no one has heard about properly designed whole life insurance. With a properly designed whole life insurance policy, most of your payment shows up in cash value immediately. And that cash value can be accessed anytime while you're alive. And you'll also see that the death benefit grows over time as well. The problem, though, is that most people are exposed to a policy that has little or even zero cash value when they start because the agent only showed one option. So what happens is people have a bad experience, and then they write the product off entirely without ever truly understanding it. Here's what I would do. When researching a whole life insurance policy, distinguish between the 2 types of policies, the type that's a scam and the type that's set up the right way. The single most important distinction is whether the policy is set up to maximize your cash value or the agent's commission. This is the number 1 difference between people viewing life insurance as a great place to put money and viewing it as a scam. Now, reason number 2 is all the proof you need that it works. So when I was a young lad in the life insurance business, I got my first whole life insurance policy with Guardian, which is a top mutual company. I paid about $200 per month for that policy, and it started with a death benefit of $250,000. Now, my income was not consistent at the time, and there were months I struggled to make that premium payment. When I look back, though, I am so glad that I kept that policy because now I'm older and that policy has more than $50,000 in cash value, and the life insurance is worth more than $380,000. If I die, my wife doesn't get the $250K. Instead, she gets $380,000. And that death benefit is going to keep growing with the cash value over time. The death benefit grows with the cash value in a whole life insurance policy. That specific policy is compounding between 4 to 5% per year, and I can access the cash value anytime I want on a tax-free basis. Now, that policy is more than 10 years old. Most people never get to this point, though, because they often look at life insurance over a 1 or 2 year window. This is a product that's going to look fantastic, but on a long-term basis. I have to get past the early years. So here's what I would do. When you look at a life insurance policy, expect that the early years will hurt. You'll have less in cash value than what you pay into the product, but also know that that's temporary. Once the compounding starts, you're going to feel motivated to add more money to the product. That's exactly what happened with that first policy I started when I was 24. Reason number 3, how to set up a policy correctly. Because getting a life insurance policy is only part of the equation. Right before I turned 31, I set up my first big policy. Now that policy had a premium of about $1,500 per month or $18,000 per year. But the policy also had what's called a paid up additions rider, or PUA rider, which I can add up to another $132,000 per year. When I add money to my PUA rider, it immediately goes to my cash value, starts compounding, and that's money I can access tax-free. So when you add those two numbers together, that's $150,000 per year that I could add to the policy. The IRS does limit how much money I can put into a policy per year and still be able to use it tax-free. The limit is called my MEC limit, MEC, which stands for Modified Endowment Contract. If a life insurance policy becomes this MEC, the cash value still grows tax deferred, but if I ever want to access the cash value, I have to pay ordinary income tax on the gains and a 10% penalty tax if I'm under the age of 59 and a half. So what I did with my first policy is I set the MEC limit at $150,000. I wanted to take this policy out and fund it for 5 consecutive years at the maximum level, $150,000, which over 5 years, that would get a total of $750,000 in cash value. My plan was to build the cash value up, then let it compound over the years and use it like my own bank or my own line of credit for business and other opportunities. Most people I speak to have no clue that this is even possible. Here's the key to getting a whole life insurance policy for cash value. First, reduce your base premium to the minimum dollar amount that the insurance company will allow. Second, add a term insurance rider to prevent a MEC from occurring, a taxable event. And third, stuff your PUA rider. You'll see with most of the top life insurance companies, wherever you set your minimum base premium, you can usually add up to 10 times that dollar amount in PUAs every year. Here's what I would do. I would not ask the question, is my policy designed for cash value? Because the agent is going to tell you yes. Instead, I would ask, how is my policy set up for cash value? What's my minimum premium? What's the most I can add to PUAs every year? What does the insurance company allow me to add to PUAs? And also, what is my MEC limit with this policy? Asking those questions will force your agent to give you specific facts about your policy, and it will really help prevent buyer's remorse. This lets you see a best case scenario and also a worst case scenario. Reason number 4 is the most inviting for a lot of people. It's having your own bank. The concept of becoming your own bank revolves around the idea of taking loans against the cash value of your life insurance policy. Whatever you have in cash value, you can borrow against any time. So for example, let's pretend you have a whole life insurance policy and you've built the cash value up to $1 million over time. When we look at the growth rate, it's compounding at 5% per year. You see an opportunity where you need $700,000 of capital. So to get that capital, you borrow against the cash value of your life insurance policy. So you take a $700,000 loan, and the loan interest rate might be around 5%. That's right around where you'll see them today. So what does this look like in terms of the numbers? Well, if we take the 5% interest cost on the $700,000 loan, that's $35,000. But you continue to earn 5% on your full $1 million as if you never touched it in the first place, which means you're still getting $50,000 even though you pulled $700,000 against your policy. And the insurance company does this, by the way, by reducing your death benefit by the amount that you borrow. But when we look at what you paid, $35,000, and what you gained, $50,000, your net result is $15,000. Whatever you have in cash value, you can borrow against any time, and the money keeps on compounding. The thing is, most people will use this concept of becoming their own bank because it is way easier than dealing with an actual bank. There's no financial underwriting, no long delays. I don't have to deal with a mountain of paperwork and a rigid payback schedule as well. You have control of taking loans, paying loans back, your billed loan interest just one time per year, but your entire cash value keeps compounding when loans are outstanding. The reduced stress is really the most appealing part to most. The last thing I'll say about this concept is that when interest rates were very low and bank accounts were paying around 0%, these policies were compounding around 4% per year. And it was that time when we landed our biggest client, which is a bank valued at about $1 billion. So here's what I would do. If you're holding a lot of money in cash just for future use, whether it's investments, real estate, business capital, whatever, I would consider whether that money is better positioned in a policy that is set up for high cash value. A lot of business owners we work with will move money that's just sitting in cash into a life insurance policy. They'll usually do this over a few years because it grows safely, is tax-free, and they can use it for opportunities. Reason number 5 is the tax advantage that completely changes the math. When I was in my 30s, I really started to learn more about returns, but especially about how taxes can affect returns. Pretend that you can get 5% in treasury bills, or let's say it's a money market. If you could do that, why would you not just put money there that you want to keep liquid for opportunities? Well, for one, you have to pay taxes on the gains every year. Meaning, if you earn 5% in treasuries, you have to pay ordinary income tax on that, and that's based on your tax rate. Say your tax rate is 30%. If you earn 5% in treasuries, you have to multiply that 5% by 0.3, which is 1.5%, then take that 5% and subtract 1.5 from it, and you're left with 3.5%. That's your real return after taxes. The point is, if I have money inside of a whole life insurance policy, earning 5%, and I'm following IRS rules, I can keep it tax-free. So if my tax rate, for example, is 30%, 5% tax-free is going to feel like I'm earning 7.1% in a taxable account, like treasuries or a money market. If my tax rate is 40%, 5% tax-free is going to feel like I'm earning about 8.3% in treasuries or a money market. Whole life insurance is often attractive to people who are earning strong income and paying a lot in taxes. If you're in your 30s, there's a good chance that your income is going to rise over the next 10 to 20 years. That's a good thing, but you'll also see the amount of money you pay in tax rise over the years as well. So if you like the idea of having money somewhere that's safe, grows consistently, and has a nice tax benefit, I would look at a policy. Reason number 6, why life insurance in your 30s is a good idea. Several years ago, I remember someone who was well known in the community, and he owned a large construction company. Now, he was over 60 years old, but he had 7 whole life insurance policies that were all more than 30 years old. He had a very high net worth with a diversified portfolio of stocks, bonds, mutual funds, and real estate. But he said something that stuck with me. He said, when I look at all of my investments, my whole life insurance policies have been my best performing asset. He said this because everything else he had went up and down in value over the years. But his whole life insurance policies just went up every single year. We looked at one of his policies where he paid a $12,000 premium, and the cash value that year grew by about $40,000. He didn't have to manage it, look at a ticker, and he didn't have to worry about anything when 2008 hit. It gave him peace of mind and just quietly built wealth for him over the years. So I think that the best time to start a policy was yesterday, but that's in the past. So the next best thing is to start a policy today. What I hear all the time from clients is, I wish I would have started this sooner. Everything else in this video is about what you gain by starting early. The last point is about what you lose access to when you wait too long. Reason number 7, the door that closes. The construction company owner I just spoke about, he tried applying for life insurance again in his 60s, but he had a lot of health issues, and it was difficult for him to get a policy that still made sense. Fortunately, he still had 7 old whole life insurance policies that he started when he was healthy, and those were compounding at a nice rate. So I'll share a personal story that's impacted me in this topic. About a year ago, I got a cancer diagnosis, and because of it, it's hard for me to even get life insurance for at least 5 years. However, when I was 24 years old and got that very small whole life insurance policy, I also bought a $750,000 policy that is called a convertible term policy. And when I was 31 and got my first big whole life insurance policy, I also got a $5 million term policy that was also a convertible term policy. So a convertible term life insurance policy is a policy that allows me to convert my term life insurance into a new whole life insurance policy, and I don't have to go through any medical underwriting. So when I got my term policies at 24 and 31, I was healthy and I got the top health rating. So what that means is I can take those two term policies and convert them into new whole life insurance policies that are even set up for high cash value. And that also means that I can get more whole life insurance without having to worry about being declined or getting a bad health rating, which gives me a lot of peace of mind. I also know how to structure the policies to beef up the cash value and make the death benefit grow quickly over time as well. But the lesson I learned here is that you can't always schedule your health changes. In fact, you never can. People who often have regrets are those who usually wait, whereas people who start early usually say, I'm glad I did that earlier in life. The thing that I'm happy about, though, is that I acted early enough to lock in some coverage so my wife and my employees are taken care of if anything did ever happen to me. If you're healthy right now and you don't have any life insurance, I would start by getting quotes at the very least. It's very easy to do. You can get them in about 2 minutes. Now, if it's not whole life insurance, that's okay. You can start with term. If you think you might want to consider whole life insurance in the future, then I'd look at a convertible term life insurance policy. So if you want to go deeper on life insurance policies and see how funding them faster can create even more cash value, watch this next.